PhD, Mirza Nawazish. Dr. Mirza has more than 10 years of academic research and consulting experience. Currently, he is Associate Professor of Finance and Deputy Director of Global MBA Programs at SP Jain School of Global Management, Dubai campus. He holds PhD degree in financial markets and an MS in quantitative finance from University of Paris Dauphine. Dr. Mirza teaches courses in risk management, corporate finance, investments, and corporate valuations to MBA classes across 3 campuses of his business school in Dubai, Singapore, and Sydney. His core research interests include financial intermediation, risk management, valuations, and asset pricing. Dr. Mirza contributes as referee for Journal of Banking and Finance, Pacific Basin Finance Journal, Economic Modeling, and Economic Research. He has worked as a consultant on various projects with International Islamic Rating Agency, Bahrain, United States Agency for International Development, and IFS Securities Atlanta. Dr. Mirza Nawazish.
Thank you so much for this introduction. Fellow colleagues, professors, my friends, a very good morning. And before I jump onto my topic, I would like to thank all of you for this hospitable conference. This is the second time we are in Pula, and trust me that this is a city we really love and we really adore. Once again, thank you very much. It's a pleasure being back again this year. Now, before I come to my talk on financial systems, I think one of the key takeaways from Professor Sharma's speech was that history is the best teacher. Now, if I may add here, Professor Sharma, history no doubt is the best teacher, but unfortunately, we are very bad students. And for that, I mean, we use smart devices, but we are not smart enough probably to program these things, these historical lessons in our system. So you talk about financial panics from global recession in 1929 to 2007 or 8. It's the repeat of the same thing. So I think one of the key takeaways we should have from this conference should be that how flexible we should be in order to cope with an ever-changing dynamic world. Now, before I go on, I obviously have to apologize from the Keynesian school of thought who believe that in the long run we are all dead. But here we are talking about 2050, right? So, I mean, that clearly means that we are looking into at least, not very long term maybe, but at least in the long term. Now, my presentation doesn't have any fancy empirical models because I knew we have a gathering from all domains, so I wanted to keep it, more understandable rather than overloading it with empirical models. So I tried to give you, some examples, especially from the region where I'm from and how, the dynamics of the economies there have changed. But before that, I would like to take you through a typical financial system. Now, a typical financial system comprises of individuals who are doing savings, and then through, some horrible-looking entities called banks and financial markets, they indulge in investments. Now, here I have a very, if I may say, thought-provoking thing. I think all of us do financial planning in our lives. We go for, retirement planning. We buy insurance products. We go for, mortgage loans and everything. How many of us actually realize that when we go to buy a financial service, the counterparty or the seller of financial product is actually selling us something which is uncertain? So if you go to get an insurance product, and they offer you a rate of return of 12% 15 years down the lane, do you think they can have 15%? Or do you think they can have even 10% or 5% with any certainty? So I think this is where the major problem of the financial system lies, that humans are not smart enough maybe to gauge these uncertainties, and they still, get into the trap of these financial products. Now, these financial products or, the financial systems theoretically will support, just a minute, business growth, followed by something which is, again, very overrated these days, innovation. And I'll come to this later, that why I believe that innovation is very much overrated, and which ultimately supports national growth. And then on top of everything, we have the regulators. Now, it's very funny. I mean, my wife helped me in making, these beautifications to the slide. I'm not very aesthetic in colors. So she put it in black. So then I realized, oh, wow, regulators are probably the biggest black box in our system, because you never know how they react. They have one stance, they lower interest rates. Then they have another stance where they will, ease out mortgage. Then they have another stance where they will overlook or, they will not look into rating agencies. And then as a result, what happens? Global financial crisis. So this is, very strange, that we live in a financial system which we don't understand properly. We live in a financial system where we are being sold some products which are not even manageable by the sellers. And then we have the regulators who can behave very awkwardly at different points in times, right? So this actually calls for a lot of flexibility and understanding and caution on our part. And same goes for the innovation, because as we all know, innovation now is, flowing over to finance or economics, financial technology as we know of. And there is a lot of issues or problems which may exist in that. So it can be possibly a new bubble, because please remember, in the history, everything which was overrated ultimately led to a bubble, a panic. Let it be, tulips in the 16th century, or it be the mortgage products which we experienced 10 years ago, right? Now, having said that, let me take you through some of the recent happenings which have changed not only, common people, but economies as altogether. And for that, I have to, take an example of the region which is GCC, or the Gulf Cooperating Countries. Now, what we have seen, these countries have been largely dependent on oil. And this is what the oil prices have been from 2008 to present. Now, how this graph had changed the dynamics of these economies. So this is where Burj Khalifa was made, right? So they were flushing with money, petrodollar, everything, and they constructed probably the tallest building in the world. This is where GCC economies were investing in all those, hi-fi malls we know now as, the world's biggest shopping malls. And then this comes. Now with this, what happened? All the GCC economies, from Saudi Arabia to Bahrain, went into massive budget deficits. And how they are bridging those budget deficits? By offering sovereign debt or bonds from the market. Now, this is a clear lesson that, if you don't plan for your future and when you have, spending which is going into, luxuries, you probably will end up borrowing to support your even daily life. Another thing which has happened, I'm not sure if you are aware of this or not, that GCC historically is a tax-free region. There is no income tax, there is no corporate tax, there is no sales tax. Right? So it was a tax heaven. I mean, it's like a dream for every employee because your money will not be, taxed by the government. But what happened? Starting 2018, because of this poor planning over here, the GCC has introduced a value-added indirect tax of 5%. Although this is still very low compared to, the developed economies where value-added tax can be, up to 20% or plus. But I mean, you can imagine that how the lifestyle of the people might change because of this, and this is likely to contribute towards some inflation at least, right? Now, just to have an idea that how much these economies borrow to, bridge their budget deficit, I have a comparative analysis over here. So in 2016, Saudi Arabia raised 17.5 billion worth of debt from the foreign market through a bond. Followed by Qatar, which is 9 billion, and then comes the UAE, which is on a slightly lower side with 6.5 billion. For Saudi Arabia and Qatar, this trend is likely to continue even going forward because it is estimated that they probably have to budget their deficit for at least 2-3 more years by borrowing more from the market. Now, there are both good things and bad things about this. Good thing is that foreign investors, by the way, all these issues, because the economies have some fundamental strength in them, so all these issues were oversubscribed. And majority of this debt was taken over by the US investors, both institutional as well as government investors, right? But the thing is that, it has actually changed how the sovereign debt market of this region is, right? So this is another example, how things may change and how things may change very quickly, right? Now, UAE, Oman, and Bahrain are slightly in a better shape because their budget deficits have been under control by 2017. So they are not likely to offer any new, debt in the sovereign markets. But Saudi Arabia, one, fact about this 17.5 billion is that this was all raised through one issue, which is largest in the history of the world. That no country before has raised capital worth 17.5 billion US dollar through a single issue, right? Now, going forward, we have Brexit. I'm leaving now Brexit for my fellow speaker here because I thought she would be speaking about it. But this is another event. Now, the point is this event may not be likely, 2, 3, 4 months prior to the referendum that we had, right? But things like these probably can occur. In financial terms, we call them black swans. But I think these black swans are not black anymore. They are more of white swans than black swans. So this is likely to have a change in trading patterns. Capital flows are likely to change because we still have to, as of now, it is still estimated what may happen. But as the Brexit contract will unfold, we will see what more changes will be there. But I think the most important would be that there will be restriction on free movement of people and migration flows. And ultimately, it is likely to impact negatively or maybe positively. I'm not going to speculate at this point in time on the economies and largely on the EU economies. And then ultimately, regulatory freedoms and business environments are still likely to be questioned. Again, this is at a time when we are being bombarded by those innovation-driven financial products, right? So we have a new thing coming up, but regulators probably have to also cope with something which is still there from the Brexit. Okay, now just a brief summary of what is happening in global financial system these days. markets are pretty slow. And this is, across all economies. So we can see an average growth rate from the two largest, geographies. We have the US GDP growth rate, which stands at around 2%, and for the EU, which is around 1.97. The government debt to GDP ratio has raised to 104% for US and 89.20 for the EU area. I think more concern is for the unemployment rate, which is again on a higher side compared to US. This is another thing which will ultimately concern these economies because banking systems are not performing well. I have the next slide which explains, these banking system, but let me share a conversation with a friend of mine. So we have this discussion on financial technology, and this friend of mine is basically a global strategist at IBM. So when we were discussing about, these disruptions which are coming up, like, financial technology, peer-to-peer lending, Bitcoins, blockchain, and everything. So we thought, what will happen to the banks, right? What will happen to these banks, these financial institutions? Will they go break? And then we realized that they will not go break. Why? Because they are already broken. And why they are broken? Here is why they are broken. They are operating at a level which is very vulnerable to the liquidity crisis. So we have not still recovered from maybe, the global financial crisis in full. And we are again sensitive to high liquidity issues. So they are lending the reds over here means that they are lending more than the deposits they are getting from the public. So this is very alarming, right? This is very alarming because if at any point in time, me, you, we want to withdraw our deposits, imagine where the banks will get money from. They can't call back their loans. Right? So that is where the banking system is already in sort of turmoil. And they are feeling that heat, and that's why, every day you hear about banks investing heavily in financial technology, in financial innovation, in new services and new products. Taking you back, so these were, some of the statistics I got with reference to financial inclusion. I think we do have a paper on financial inclusion in one of the sessions later, but it is interesting to see, what this is. So, although there can be many more, measures to quantify it, an interesting measure I got was to see that how many, people across various regions, across various income groups have bank accounts. So while you can see that I have, clubbed various countries over here based on, their currencies or high income, low income, and then this is, by the way, Europe and Central Asia, excluding the high income countries, and then Middle East and North Africa. But then I saw Singapore. So for Singapore, it is amazing that, it's a small city-state, that on average, every adult has around 2.3 bank accounts. Right? So clearly, the banking system is at a mature stage where financial inclusion is on a very high side. But I think the trouble is here. Low-income countries, where this financial inclusion is very low, 87 bank accounts per 1,000. Because see, this is very critical. If you want to progress, if you want to have, more people in the system, more people contributing to the economic development, financial inclusion is a key. Right? So this is something which probably have to be dealt with. And I think given that now the good side about the technology is that probably it is likely to include more people into the financial system through many platforms like peer-to-peer lending, like InsurTech, like blockchain, etc. Coming back to, the horrible looking figures that I had on the banking system, you can see that the margins are very thin. Right? So when the margins are thin, what these banks will do? They will be more aggressive, they will take more risk, and when they take more risk, what will happen is they tend to become more vulnerable, and ultimately there is a chance of another collapse, another financial collapse. Credit infections are very high, so non-performing loans are on a very high side. And again, this region 9.25 is on maximum for Europe and Central Asia, which is mid to low income countries. Now this together with a credit to deposit ratio of 105%, this is really this should keep the banking system in these countries at their toes. They need to correct it immediately, otherwise there may be a systemic failure as such for the banking system. Okay, now what the future is likely to have for the financial system at large, and more importantly for the banks in specific. So first thing which is going to disrupt their business model, or probably has already disrupted the business model, is the financial innovation. Now, with financial innovation, you can have multiple products, multiple things at the same time. You even have alternate sources of funding. I think the biggest challenge to growth historically was that small and medium enterprises used to find it very difficult to raise finances. But with peer-to-peer platforms, crowdfunding platforms, I think that thing is already taken care of. Although, again, there is a regulatory side to these peer-to-peer and crowdfunding platforms, which has to be dealt with care, or they will again become another source of ultimate crisis. The second thing where these banks and financial system has to ultimately focus is offer many products. I think we don't have now time to go to institution for different services. So we want to have credit card from the same bank as our bank account. We want to have maybe mortgage from the same bank. We want to have car loan from the same bank. We want to have an insurance from the same bank. So this portfolio of new services have to be ultimately offered if they want to succeed or if they want to have any success. Competition is another factor which would be there. See, historically, banking sector or financial sector was not subject to high competition, and even if it was never a price-driven thing. Most of the banking and financial products and financial services have been on the consumer or the customer satisfaction. But now it has become price-driven. Now customers, since they have many options, and with financial technology and financial innovation, these options are going to increase. This thing is probably be more into the system that they have to care about the margins and the pricing which is there. Then we have seen a wave of consolidation. Now most of the consolidation in financial system is because of the regulations or the regulatory driven coming from those heavenly brains of Basel people. Now consolidation is good. This is what we know, because when a bank is large enough, it may not fail, right? Because it may have capacity to absorb shocks, capacity to absorb losses. So this is where the mindset is that when a bank or when an institution is too big, it is too big to fail. But my version is different. My version is that when it is too big to save also. So you talk about Lehman Brothers, it existed for 190 plus years, but it collapsed over a weekend, right? And now, I mean, this is something I usually, speak about. When we teach in business schools, in a typical risk management course, we do cases on the failure of Lehman Brothers. Can any one of us think that we can do this case prior to 2008? Prior to 2008, it was all the success story of Lehman Brothers and, those hi-fi investment bankers. But post-2008, all we know is that, they were driven by greed. Well, they were always driven by, driven by greed. The only thing is, we realize when one is going to fail. So this is where we should understand that our cost of failure is sometimes too high. Our cost of failure may be too high that it will erode the success of, 2 centuries, right? So that is an important thing which these banks, these institutions have to, take care of. That consolidation is good as long as you don't become too big that at the end you become a systemic shock yourself. Then we have deregulation and finally the aging population. Now, aging population is important from 2 aspects. One is that, when the population is aging, that means most of the population would be retiring. So where the public funds in form of taxes would be coming. This is a huge issue in US, where their, unfunded liabilities or pension liabilities have become immense because, they follow what we call a generational accounting. So one generation, when they are working, their taxes are going to be paid to the generation which was before there. But imagine if, your later workforce which is coming in is small than your generation which is, getting into retirement, and they have, claim of medical and pension benefits. So there will be an imbalance. And that is the reason I think this is one of the very critical areas which even in all US presidential elections, this issue comes up of medical benefits and, social benefits post-retirement. Going forward, now on the financial innovation, now this may not be very visible, but I'm just reporting a survey from PricewaterhouseCoopers that how much disruption and in which area the disruption from financial technology can be caused. So most of the disruption, it is expected, is coming to consumer banking. So consumer banking is where we are involved. So you will have alternate sources of raising capital, of funding your needs from crowdfunding to peer funding. And then it spans to basically all areas of financial services. Even if you talk about insurance, it's there. Although insurance may have some regulatory aspect which is still need to be clarified, and then ultimately even the reinsurance, right? So this is where your financial technology will be ultimately coming in, and it is likely to disrupt more and more in detail. I mean, just to quote you here, it's not only financial technology which will change the landscape. It is also Internet of Things which are also going to cause a lot of disruption. Right, and for that Internet of Things, I mean, it is estimated that financial services probably have to invest as high as $2 to $3 trillion to cope with that. Right, so this can be, the imaginable scale of the amount these banks have to put in for the survival. And why this survival is important. Now, we know now about Uber, we know about Apple, we know about Samsung, we know about Amazon, and we know about their success, right? All of us. Now, Amazon did not succeed because, let's say retail industry was not doing good. Amazon succeeded because it was more consumer-centric compared to the retail industry. So now the age is more about consumer preference and consumer treatment. Uber has taken over, the taxis and, the cab system because there was no, uniform mechanism of pricing or availability for the conventional cabs. So again, consumer, facilitation. So going forward, it's going to be all about how your consumers are happy with your services. And one way to, achieve that is through the financial technology. And that is, where the role of innovation is ultimately coming in. Okay, now, what could be the possible challenges which are there going forward, especially, with these type of things? First one is, again, the public confidence. Because for any financial system to ultimately perform, public confidence is imperative. If we don't have public confidence, no system is likely to work. And this public confidence is maybe become a questionable thing when it comes to, technology-driven financial systems. So there has to be a lot of care and a lot of effort from the regulators which should go into this. Then new technology. So I have quoted few of them. These days, we hear a lot about, blockchain and Bitcoin and everything. Bitcoin is, by the way, not the single cryptocurrency. There are many others. Bitcoin is probably the oldest one. Now, again, proponents and, so proponents are again, trying to have this currency as an alternate payment system compared to our conventional currencies. I will not comment on this, but I will just leave this open, again, for those black box people. That will they let an alternate currency, prevail in the economy? What will happen to the central bank? What will happen to your monetary authorities? Will they let this happen, right? Then these, technologies are primarily, getting popularity because of their low operating costs and ultimately the ease of use. Because as of now, I mean, on using this device, you can actually, do whatever you want. You can pay your bills. You can, book a plane ticket. You can even, check in using this. You can do anything you want. I mean, every transaction, you can have your investment portfolio on this, right? So with this type of access and, with this type of development, again, the downside may still remain, which is that how to cope with the new challenges which may appear. And I think one of the challenges we recently saw was, again, a cyber attack. I don't know if you are aware of the recent, happening. It put a lot of pressure on, users across globe, and there was a lot of, again, stealing of valuable information, right? So that brings us to system security, how secure the system would be. Because see, this is again about mindset. Now, probably, when we talk about the new generation, which are mostly our students now, they probably could not think of anything, beyond these smartphones, right? They probably in some time will not know that checkbooks used to exist, or maybe, there used to be some, physical checks that you had to write. So for them, it may be this adaptability may be easy, but again, this may be a questionable thing when it comes to, relatively older generations or the decision makers as such. Then we have, as I, posted earlier, that there has to be, more services under one roof. So we have to have a changing mix of, financial service suppliers, and there have to be new markets, because existing markets for the financial products, for the financial system are pretty mature, right? But again, if you innovate, you have the same problem of, ultimately falling to the trap of, the risks. Consolidations and convergence, again, as I said earlier, that it may, in theory, reduce the risk, but it may have its own problems, the size problem, right? It may have a problem of adaptability, because see, when we talk about consolidation across borders, sometimes the work cultures are very different. So it's not only merely a financial issue, it becomes a human resource issue also. It becomes an organizational structure issue also, right? So the great complexity may increase the overheads or the operating costs, which actually will result in, negative synergies for any consolidation, any merger, any acquisition as such, right? And then again, the regulators, because they are going to be, like it or not, they are going to be there as long as a financial system will exist. So they have to reduce barriers for, again, cross-border diversification, again with care, because see, cross-border diversification may invite new risks, right? Then portfolio choices by financial institutions, that have to be relaxed. As of now, I think regulators are telling even, these financial institutions how to breathe, how to, take bath, how to, open the door, and, what timing should follow. So that should be relaxed. I mean, these financial institutions should be allowed, at least some autonomy. Obviously not 100%, but there has to be a balance between what these institutions can do based on their self-assessments, and ultimately, what these regulatory agencies need to do. So they should be a watchdog and not a bloodhound. I mean, they are not there to, eat up the financial institutions. They are there to moderate and monitor, right? So they should moderate and monitor rather than, going into more of governing these institutions as such. Now, having said this, I believe personally, now this is my opinion, I mean, you may disagree with these, some possible, directions on which we should be looking into finance, especially in maybe economics, is not what is, what we have been doing conventionally. So my suggestion would be that if we want to work on, more macro issues, it is going to be still, financial stability and economic growth. But probably it has to be now a financial stability and economic growth, which is number one, very volatile, right? So we don't have periods of stability now. And number two, which is actually more important, technologically driven. How technology may impact your financial stability and economic growth. Then this is, more of a global approach or a macro approach. Then macro and micro could be that how using these new technological innovations, we can ensure basically financial inclusion. Because the more people are coming into your system, more beneficial it will be for economy overall. And then finally, which is more of a micro level view, how disruptive these innovations can be in financial services. Now, for the third one, as of now, the data probably is not very exhaustive, because these, financial platform, either they are insurtech or crowdfunding or, robo-advisors. There is no disclosure as such or disclosure requirement. But I think this will be at least, a good direction to start with, that how a conventional robo-advisor can outperform a conventional business manager, fund manager, right? Because I think in finance, we usually talk about asset prices and we talk about, mutual fund performance, hedge fund performance. But I think it is important now to see that compared to, these conventional parameters, how these new technologies are likely to perform. Because with a robo-advisor, you don't need a fund manager. So there will be less humans which will be involved, right? So I think this is an area where we need to at least focus more on, as a research, both in academics as well as on the applied side. And I think your new journal, which is, I think, targeted toward innovation, can be a very good platform for, this. So I think this is all from my side. We are already running late. I tried to be a bit, on time. So thank you very much. I don't know what's now the format of questions, if any, No. We can all see, right now I'm working more towards, these areas of financial innovation and, these finance as per the technology. So if you have any research interest on that, we can actually, catch up during our coffee break and later. Right. Thank you very much.
Thank you. Some certificate of appreciation for our professor. Yes, thank you so much.